Good morning, everybody. So thank you very much all for coming today, and it's a very warm welcome from us. Put that down there. A warm welcome from us at OMFIF. We're now launching the Global Public Investor. We're getting on to being 10 years old, so there's a really good track record here, and it's great that we can do it again in a really exalted surroundings here in number 1 Great George Street, where we've been on many occasions over the years. And of course, it's so much better when you can actually meet each other in person. There may well be some Zooming going on here, I don't know, but it's clearly better that we can meet in person and allow so many great interactions. And the reason why we set up this Global Public Investor now a decade ago is to try to record the pace of change in the way that the global public investors, that is the global central banks, the public pension funds and the sovereign funds are deploying their assets around the world. And with the latest events in Ukraine, the war in Ukraine, plus the COVID, plus this resurgence in inflation, it's taken everybody somewhat by surprise. There's clearly more to talk about now than in any other year. The book itself is actually got smaller than in previous years, but I would say it's more action-packed and it's more compacted and it's more full of information. And the survey in particular is well worth looking at. But for those who are interested in all the hard copies, I do have a collection at home just of all the different books that have come out now for nearly a decade. It's really like the Wisden Cricketing Almanac for those of you who take cricket seriously, as of course we all do now that England is starting to do better. And so if anybody's interested in having the really good hard copies, see me afterwards because there are back numbers available. I'm now going to introduce Taylor Pierce, who's our economist, who's going to be taking you through the findings of this year's survey. Got some really stunning material. And then we have Marta Keightley, who's Deputy Governor of the National Bank of Poland, who will be talking later, after Taylor, on some of the findings. And I'll be subjecting her to an ever so light grilling about some of the policies in Poland regarding inflation and other matters. So thank you all for coming. And over to you, Taylor.
Good morning, and welcome to the Global Public Investor Report launch. My name is Taylor Pierce. I'm economist of OMFIF's Monetary and Economic Policy Institute, and it's a pleasure for me to introduce our key findings today. So as David mentioned, this year's report is a bit different in form than our previous reports, and it focused exclusively on central bank reserves managers. We had a very robust sample of 73 central banks respond to our survey. So let's take a look at the data. To start off by setting the macro scene, when we asked central banks reserves managers to choose the top 3 factors affecting their reserves management this year, perhaps to no one's surprise, inflation and geopolitics are at the top of the list, with nearly 90% of survey respondents reporting those two. So they were asked to choose their top 3, and as you can see, the 2 bars on the right-hand side are approaching 90%. It's also worth pointing out that just 1 year ago, in GPI 2021, the number 1 factor affecting reserves management was the expectations of major central banks moving further into negative rate territory. So as we can see, we're in a completely different environment than we were last year. Of course, most acutely pertaining to the Russian invasion of Ukraine, but also as a result of the ending of pandemic-related emergency programs. So to continue on the macro setting, almost half of reserves managers believe that inflation will remain high over the next 12 to 24 months. And if we break this down regionally, which we do in the report, which you can see, we actually find that 60% of institutions, so nearly 2 in 3, outside of the Asia-Pacific region, so the rest of the world apart from Asia, believe that inflation will remain sustainably higher, whereas most institutions in the APAC region believe that inflation will be more volatile but not persistently higher. So perhaps this is due to insulation from the war in Ukraine relative to their institutional peers, but definitely an interesting regional kind of differentiation. So now moving on to asset allocations and strategies, our third key finding is the importance of capital preservation and liquidity in the current environment. These were by far the most important investment objectives that we found. The light blue bar is the number 1 reported investment objective, and the dark blue bar is the number 2 most important investment objective. And capital preservation was also the most important factor in diversifying reserves this year. And this saw a pretty sizable increase from 30% of central banks listing capital preservation as the most important factor in diversifying reserves to 44% this year. So I guess looking forward, the question will be whether capital preservation in the current environment actually equates to minimizing capital losses. We can talk about that perhaps in the panel. So continuing with the asset allocation strategies, despite these objectives, our fourth key finding suggests that reserve managers have resigned to a period of poorer returns. We see that around 70% of reserves managers, the first 2 columns, if you add those up, say that they will not be making any fundamental changes to their investment approach despite the surge in inflation. Only a slight majority will become more active in their portfolio management, and this is likely to involve more marginal shifts in asset allocation rather than major strategic shifts given the radical uncertainty in the current macro environment. And finally, on the topic of asset allocation strategies, our fifth key finding is that fixed income portfolios are shifting to a shorter duration. So after a decade of low interest rates, which were encouraging government bond markets to move further along the maturity curve, we now see that that trend may be reversing. So we see anticipated net decreases of holdings of longer-term debt, these top 2 bars, while reserves managers plan to move into more liquid holdings at the shorter end of the curve. And it's worth noting that last year, bonds with maturities of 5+ years showed a net positive shift in allocation, so this is a pretty significant change. So on the topic of utilization of reserves, we find that central banks are prepared to use fewer of their reserves in a crisis than in previous years. So nearly half of reserves managers see a case for continued accumulation of foreign exchange reserves, and 60% consider a drawdown of foreign exchange reserves as the most effective safety net during a period of stress. This is compared with IMF facilities or repo markets, et cetera. And this is up from 47% last year. So drawing down FX reserves is more important, but at the same time, the leftmost bar, we see that the percentage that would deploy 30% of the reserves in the event of a currency crisis has nearly halved, from 59% last year to just 33% this year, which is quite significant. And then moving to thematic investment, we've been collecting data on ESG for a few years, and this year we see that green bonds are becoming a more universally accepted asset class. So 98% of the central banks which hold ESG assets have green bonds within their portfolio. We've also seen a significant increase in holdings of other sustainable bonds, the second column on the right-hand side. These include assets such as social bonds or transition bonds, SDG bonds. This saw a significant increase from less than 10 respondents holding these types of assets last year to over 40% this year. So huge growth in interest there. And we did find that there are continued challenges with monitoring ESG portfolios, with the majority of institutions citing lack of data as a major barrier to the further incorporation of ESG considerations into their portfolio. And be sure to check out the report because we have a lot more data on ESG and social bonds in particular, including some year-on-year trends there. So moving on to regional asset allocation, we found that despite reported expectations to increase exposure to the APAC region, which you can see in the upper 2 bars, 40% of respondents last year said they plan to increase their holdings in the APAC region, versus, I believe, a slight net decrease in euro and around pretty steady for North American assets. But we also find that aggregate portfolio investment in Asia actually fell slightly this year. So it fell slightly from 13% of average portfolio to 11% this year. So perhaps this is a flight to safety phenomenon given the volatility, but this is also a significant finding given that the trend toward diversification for the Asia-Pacific region is a longer-term trend that we've seen over the past few years. And related to this is that while interest in the renminbi as a reserve currency is growing, major obstacles still remain. So allocations to RMB reserves rose from 1.75% of portfolio allocation last year to 2.5% this year. And around 30% of respondents plan to increase their renminbi holdings with diversification, increased importance of China in the global economy, and higher yields as the main factors cited when driving cited to drive this trend, excuse me. At the same time, however, 71% of respondents cited geopolitical concerns as a potential barrier to further investment in China, and an additional 63% reported poor market infrastructure as a key concern. The report features a series of regional spotlights, including a spotlight on the APAC region, and the Global Flows chapter, and kind of investigates these trends more in depth as well, so be sure to check those out. So finally, our last key finding is that the euro is struggling to gain traction as a reserve asset. Can you hear me? Did the mic turn off? Can you hear me? Yes. Okay, so last key finding is that the euro is struggling to gain traction as a reserve asset. So as we can see, our year-on-year findings show that allocations to euro denominated assets have declined over the past 12 months, and this is compared, this is the bar chart, and this is compared with a slight increase in USD denominated assets. At the same time, despite the next generation EU's promise to transform the region's bond market and promote the euro's position as a reserve asset, only 13% of reserves managers to date have purchased NGEU bonds, and this number only includes 27% of European central banks. So this shows the struggles of the euro, and perhaps it's already being eclipsed by the renminbi as a challenge to the dollar in terms of king reserve currency. This concludes the key findings presentation. Thank you very much, and I'll now hand it back over to David.
Thank you very much, Taylor. So I'm now going to introduce Marta Keightley, who's the first Deputy Governor of Narodny Bank, Polsky. So it's a great pleasure for you to be with us here today. Thank you very much for coming. And so you're going to be giving us an assessment of the Polish situation viewed through the lens of our findings, and then we're going to have a little chat on these chairs over here. So over to you, Marta. Thank you for being here.
The mic is working. Great. So, ladies and gentlemen, I'm honored to address this distinguished forum on the occasion of Global Public Investor 2022 launch. In my speech, I would like to discuss the current macroeconomic outlook in Poland and the broader CEE region, key challenges that the region is facing, related in particular to the Russian military aggression against Ukraine and its economic impact. Some major policy initiatives we have undertaken over the last years, as well as the challenges and opportunities facing public investors. As you all know very well, the world is currently going through turbulent times. Our economies are still recovering from the COVID pandemic of 2020-2021 and associated deeper economic recession caused by stringent lockdowns measures and sanitary restrictions implemented to save lives and avoid a breakdown of national healthcare systems. Today, after a few waves of the epidemic have passed and broad-based vaccination programs have been successfully rolled out, it seems unlikely that the lockdowns will return, with the probable exception of China. But the shadow of the pandemic crisis still persists. Over the last year, a sharp revival of global consumption demand, unmatched by the production capacity, stifled by lingering COVID-related supply chain disruptions, presented us with inflationary pressure of magnitude that we haven't seen in decades. On top of that, the horrifying military invasion wrought on Ukraine by Russia has strongly affected our region through three main channels. Through sharp reduction in supply of energy resources and growing commodity prices, increased geopolitical and macroeconomic uncertainty, and the arrival of a massive wave of Ukrainian refugees for whom especially Poland was the #1 destination. However, despite all these global and regional turbulences, there are many reasons to be optimistic with regard to the macroeconomic outlook in Poland and the CE region. The Polish economy has been recovering from the pandemic faster than most EU countries, especially that the recession itself was relatively mild in Poland, which we owe to the favorable structure of our economy, low shares of most affected sectors in gross value added, such as tourism and diversified exports. The pandemic didn't incur permanent losses in terms of GDP, employment, or for that matter, any other measure of economic activity. Poland's GDP exceeded its pre-pandemic level already in second quarter of 2021 and keeps growing. Our economy's resilience to the pandemic crisis built on a number of decisive advantages, such as a large internal market and increasing productive economy, favorable labor performance, competitive exports, and a robust banking sector. These strong fundamentals are reflected in high potential GDP growth, estimated by the European Commission at 3.6 per annum in 2022, way above the EU average. In the first quarter of 2022, the expansion of the Polish economy in terms of real GDP continued at a rate of 8.5 year-on-year. Private consumption increased by 6.4, supported by the expenditures related to the influx of refugees from Ukraine, while investment grew by 4.3. Industrial production and construction output are growing fast as well. All these high growth rates are a clear indication of strong post-crisis recovery in the real economy, even if they are, of course, not sustainable over the longer run, for reasons that are both fundamental, potential output growth isn't as strong, and cyclical, related to inflation and interest rates, of which I will speak later. Another reason to be optimistic about the macro outlook is labor market performance. The unemployment rate in Poland sits at its historical low of just 3%, well below the EU average, while the employment rate and labor market participation are growing. Polish exports have also proven very resilient to the face of the COVID crisis. Exporters maintained their high price cost competitiveness, and the economy benefited from a particularly favorable structure of foreign trade, including mainly consumer goods and intermediate goods, relatively less affected by the pandemic crisis than service and investment goods. Furthermore, generous financial assistance measures for firms introduced in response to pandemic shock and depreciation of Polish zloty further supported export performance. In the first quarter of 2022, Polish exports of goods and services exceeded pre-pandemic levels by 12% relative to fourth quarter of 2019. As regards the external position, in the pandemic year 2020, Polish current account balance reached its record high of 2.9% of GDP plus, driven by improvements in trade and primary income balance. In 2021, the current account balance went back to normal, dropping to minus 0.6% of GDP due to counter-cyclical decline in the trade balance and increase in primary income deficit, stemming from higher income of foreign investors, direct investors. In 2022, this decline continues. It's minus 2.2% of GDP in the first quarter of this year, amid strong domestic demand and high commodity prices in the face of the Russian invasion of Ukraine. Poland's external debt as a fraction of GDP has been narrowing since 2017 and has a favorable structure. Namely, it's concentrated mostly in enterprises and general government sectors, and over the 2/3 of enterprises' external debt is either intercompany lending on trade credit. In turn, Poland's net international investment position which is historically used to be strongly negative because of the large cumulative FDI inflows, over last years has been systematically improving. In fourth quarter of 2021, it amounted to minus 39.6% of GDP, and it's firmly predicted to continue improving in the future. All in all, the Polish economy, compared to other EU countries, was among the least affected by the COVID crisis 2020, notwithstanding all the silent characteristics of our economy, a large internal market, strong potential output growth, favorable labor market performance, competitive exports, and robust banking sector. This outcome was also to a large extent driven by bold and timely policy interventions. Soon after the pandemic broke out, the Polish government quickly rolled out the anti-crisis shield, a series of generous support measures directed at employees and enterprises whose businesses suffer from the lockdown and sanitary restrictions. The anti-crisis shield included also postponing some administrative and tax obligation and introducing a guarantee program by the Polish Development Bank. Concurrently, Narodowy Bank Polski cut its interest rates to almost zero, reduced required reserve rate by 300 basis points, introduced repo transactions, discount credit, as well as purchased treasury bonds and debt securities in order to provide the government with liquidity it needed for implementing the anti-crisis shields. The Polish Financial Supervision Authority in turn increased flexibility of supervision measures, carried out actions aimed at facilitating smooth functioning of banks, insurers, and capital markets, and implemented measures in the area of provisioning and classification of exposures, as well as capital and liquidity requirements. Finally, the Financial Stability Committee released the systemic risk buffer 3% and reduced risk weights for selected loans to enterprises. Macroeconomic data from 2021-2022 confirmed that these policies were highly effective. None of the feared hysteresis effects, such as bankruptcies, rising unemployment, and loss of physical and human capital, have materialized, so that the temporary disruption in economic activity in 2020 did not produce permanent losses. Moreover, the final cost of the anti-crisis shield programs were quite contained. The general government deficit did spike in 2020, but it didn't exceed the 60% threshold, after which immediately fell from 57.1% in 2020 to 53.8% in 2021. Unfortunately, over the course of 2021, it became clear that the COVID crisis has produced an additional unexpected outcome: the global inflationary pressure. Pandemic-related lockdowns, travel bans, sanitary restrictions, and widely adopted expansionary fiscal and monetary policy induced a pile-up of forced savings. Once the pandemic restrictions were lifted, the saved money began to be spent, the deferred demand skyrocketed. This fast-growing demand collided with sluggish supply, which was still crippled by the lingering consequences of the pandemic. Furthermore, commodity prices, including oil and gas, were also driven up by the geopolitical factors and climate policy. All this triggered inflation, which, contrary to expectations, turned out to be universal, high, and persistent. In Poland, CPI inflation ramped up throughout the second half of 2021 and the first half of 2022, reaching 15.6 in June 2022. Inflation net of food and energy prices grew as well, though not as strongly, amounted to 8.5 in May, representing the rising prices of non-food goods and market services as a result of cost pressure and persistent tension in global supply chains. At the current point, the primary goal for Narodowy Bank Polski and other European central banks is to pursue predictable, credible monetary policy, able to limit the transition of global price shocks to domestic inflation and keep domestic medium-term inflation expectations anchored. Stepping up to this challenge will allow to avoid second-round effects and help inflation rates gradually return to the target. In order to reduce the risk of inflation staying above the target in medium term, since October 2021, NBP has been forcefully tightening its monetary policy, among other means, by increasing interest rates. Until June 2022, the NBP reference rate was raised by 5.5 percentage points from 0.1 to 6%. Further decisions of NBP, including the possible continuation of monetary policy tightening, will depend on incoming information regarding the outlook for inflation and economic activity. NBP will take all necessary actions in order to ensure macroeconomic and financial stability, including, above all, reduce the risk of inflation remaining elevated. However, as the current inflation episode is a global phenomenon, any small open economy must strongly rely on global central banks doing their jobs as well, reducing global demand and smoothing the global inflationary shocks. We count on that, and we are looking forward to seeing that in practice. The next point I'd like to address today pertains to the macroeconomic consequences of Russian invasion of Ukraine. The first and foremost channel of economic impact of this calamity is through commodity prices. Inflation processes in Poland and other CEE economies have been strongly amplified by the sanctions imposed by EU on Russia's commodity export and Russian retaliation. Ever since the Russian military invasion began on February 24th, commodity prices in international markets are on the rise. The problem is further exacerbated by the immediate need to seek alternative suppliers of oil, gas, and coal, which implies incurring additional shipping and transactional costs. In 2020, about 70% of Polish consumption of crude oil and 48% of natural gas was covered by Russia's supply. And now all this must be replaced. Additionally, the Russian invasion of Ukraine has also jeopardized the global supply of grain, such as wheat produced in huge quantities in Ukraine and southern Russia. And while Poland did not import grain from these countries, the ensuing global shortage will certainly add to the already substantial growth in food prices. The second channel of impact is through elevated macroeconomic and geopolitical uncertainty. Geographic proximity of the war has led to increased risk aversion among international investors, which especially immediately upon impact resulted in currency depreciation and decline in financial assets prices. Over the longer run, as the escalation of war beyond Ukraine remained unlikely, this channel of impact subsided. Particularly that supply chain disruptions related to linkages to business based in Ukraine and Russia proved to be relatively minor. Specifically, Polish companies are strongly integrated in value chains centered in the EU, particularly in Germany, while their trade links to Russia and Ukraine are generally limited to the suppliers of raw materials and selected agricultural products, which can be bought elsewhere. The third channel of impact relates to the inflow of refugees from Ukraine. According to United Nations data, for June 28th, Poland hosts about 1.2 million refugees from Ukraine, down from a peak of about 1.7 million in early April. In the short run, the arrival of such large additional population has caused a substantial increase in domestic consumption, demand, and expenditure of the state budget. Over the longer run, though, this additional population will likely provide a boost in employment and overall output. However, the lingering military conflict in Ukraine makes refugees' plans for the future highly uncertain, particularly in light of the fact that the demographic structure of the refugee population. About 47% of this group are children, whereas about 95% of working-age refugees are women, revealing that the demographics of the immigrant population will change once the families unite, whether it's in Poland, Ukraine, or elsewhere. My final remarks pertain to the challenges and opportunities facing public investors. Namely, the current macroeconomic environment presents numerous challenges for central banks, not merely as monetary policy makers, but also as public investors. Let me illustrate this point using the example of Narodowy Bank Polski, which I obviously know best. As a reserve manager, NBP currently holds FX reserve with a market value of close to 120 billion euros, broadly diversified between 7 of the most liquid global currencies. Most of our fixed income investments have traditionally been in highly rated government bonds, but in 2020 we have also green-lighted equity investment, initially in the US and Euro portfolios and subsequently also in the UK. Such broad diversification across currencies and instruments has worked quite well for us over the years. But of course, the recent market interest rate increases, most notably in the US, have considerably depressed fixed income and equity market valuation, dampening portfolio returns. Frankly, from a market perspective, 2022 has so far been unlike anything we have seen in decades, and not just in terms of the sheer size of the downwards in perspective assets, but also their strong correlation. Specifically, if we take a really long view of history going back to the 1970s, there were exactly 6 instances of US Treasuries suffering losses on annual basis, but none of them as large as the year-to-date figure of minus 8.5%. More importantly, whenever US Treasuries sold off, equities tended to deliver decent positive returns. On the other hand, whenever equities suffered, example in 1990 or 2000, bond returns have more than offset the decline. So it is perhaps fair to say that this time really is different. But I think that when assessing these market developments, public investors should embrace the wise words of the serenity prayer. Grant me the serenity to accept the things I cannot change, especially because those things do have a silver lining. After all, the valuation losses I just mentioned are not due to credit risk, but simply reflect the high level of market interest rates, which translates into higher interest income for bondholders. Eventually, the gain from higher interest income will offset the price losses. And while this effect might take some time to fully materialize, most public investors enjoy the luxury of a structurally long investment horizon, which should help them look through mark-to-market volatility. Clearly, this is easier said than done, and sometimes even public investors may need some help to enhance patience, which brings me to the second line of the serenity prayer, which asks for the courage to change the things we can. Our approach at NBP has been to take an honest view of our portfolio holdings and acknowledge that despite nominally active management, some of our allocations are de facto intended to be held indefinitely or until maturity. To give a specific example, our largest portfolio is in US Treasuries, and while we target a duration of around 3, to limit its mark-to-market volatility, in practice we do not foresee ever leaving this deepest and most liquid segment of the global fixed income market. Against such backdrop, in December 2021, we have decided to take a slice of the US portfolio and designated it for accounting purposes as held to maturity. This allows us to value the portfolio at amortized cost after then making each position, rather than marking each position to market. The end result is that the portfolio contributes only yield income, protecting it from the adverse effect of price-related volatility. Of course, one has to be careful in designing such held-to-maturity portfolios because they clearly involve some restriction on liquidity, which is typically a #1 priority for central banks. However, this may be a good trade-off given the circumstances, especially when it's judged that the current level of reserves is more than adequate, as it is the case of Poland. Thank you very much for your attention.
good speech where you bring together the macroeconomic aspects in a very forthright and clear way, plus the reserve management question which you addressed at the end. So thank you very much for lifting the veil on the thinking, particularly this aspect about the hold to maturity and mark to market. I think it's vitally significant. We've got just about 10 minutes, so we won't go through a whole series of questions, but I do want to just come back to this question of inflation. Now, our survey, as Taylor showed, demonstrates that the reserve managers that we have polled in more than 70 central banks are much more pessimistic than their policy-making peers in the central banks about the ability of bringing inflation under control. You use the words high, universal, and persistent. Do you share this skepticism about whether the world's central banking community can actually get their act together?
They can. So I think it's two things. So I don't think there is distrust in the rate setters. I think it's the tool is there. We know it's working very well. But with this type of inflation, the supply side inflation coming from outside, we know that the cost of keeping raising interest rates is very big. So I think there is a limit to the cost we are able to pay.
You've clearly got inflation above average, 15%. Your policy rate is now 6%. So your interest rates are still, in real terms, very negative. You demonstrate that Poland is going through a very good economic phase in terms of expansion. Immigration will possibly help that. Are you worried about the financial stability aspects of having still such a wide negative interest rate in real terms?
I mean, we see that the raised interest rates, the raising of interest rates is working. So we see it when we look at mortgages and the application for mortgages and the number of the mortgages which are granted by banks. Currently, they dropped by 50% basically compared to last year. So it's definitely working, and we see it in all sorts of sectors, especially in the construction sector. So I think as I said, we know the tool, we know it's working, and it's a matter of time because, as you know, it takes few quarters for the interest rates to have a full effect on the economy. For our economy, it's between 4 to 7 quarters, the maximum impact of the raised interest rate. So, we have all sorts of discussion because there are two major problems in Poland at the moment, which is inflation and the war. And we keep talking to politicians, to all sorts of people about the inflation. We are explaining, what we are doing. And the problem is that people are both hit by this very high inflation, because so far the wages, there was a really strong growth in wages, but now the wages are not keeping up with inflation anymore. So households are really feeling the problem with inflation and the fact that their purchasing power is vanishing. But also they see that the increase in interest rates has a huge impact on their spending.
You mentioned a possible second round effect, and one of the reasons for this very big increase, relative increase in the Polish interest rates is to dampen down these second round effects. But as you say, ordinary families are feeling the squeeze. Where do you see wage growth in the next 12 months in Poland?
It's going to drop a bit. So at the moment, when you look at the private sector, it's so it's for the last month, for May, it was 13.5, and inflation was 13.9. But the overall across the economy is lower, so including public sector and these tiny enterprises, it's about 10%. So they are feeling the impact on inflation, and on top of it, they are feeling our increase in interest rates. So we are communicating, and we are trying to explain that we are rising interest rates really decisively, because it's a huge growth from 0.1, from basically 0 to 6% over a very short period of time, because we started raising in October last year. And we are trying to communicate that it's going to go up in order to dampen the inflation, and in order for us to be able to lower the interest rates once we see that there is no danger of the inflation.
What does the government say about this? You can't be the most popular people in town if you're raising interest rates. On the other hand, your boss, Mr. Klapinski, has just been renewed for a second term, so he must be doing something right. Do you have any feeling of what the government thinks about this very pronounced rise in interest rates?
I mean, they see the problem of inflation. It's a huge problem everywhere. So whenever you talk to other central bankers and politicians from different countries, it's the same problem. You know, people keep talking about inflation. It's a huge political problem. So they know we are doing the right thing. You know, we have to raise the interest rates in order to stop inflation from rising. And I think, of course, it's hard for the households, but hopefully we communicate well enough that people understand that it's just, you know, it's a bitter medicine. We are trying this phrase because it's really important to stop it coming up.
Just one more question about inflation, and then a couple on the reserve management question, and then we will hand over to Ellie Groves. But on the inflation question, you said, I thought rather pointedly in your speech, we expect other central bankers to do their duty. You use words like that. Do you think the European Central Bank, which after all is a very large and important central bank next door to you, do you think that they are doing the right thing? You are a member of the European Central Bank. Do you think they're being a bit slow, a bit sluggish in raising interest rates? Because after all, we have inflation of nearly 10% in the EU as a whole. You're not a member of the euro, and yet inflation is expected to be rather persistent, and yet the interest rate is still negative. So what do you say about your neighbour, the ECB?
It's hard to comment on someone else's monetary policy because you know, we wouldn't want other, you know, decision makers
you're
to
saying
comment
exactly,
on our.
You're saying exactly the right thing, Marta, to make sure that you will remain for many years.
It's not that, it's really very, very hard, and you know, it's the same with our situation. You know, we get criticized that we started raising interest rates later than Hungary and the Czech Republic because we have our countries in our region, central banks, which started raising interest rates 3 months before us. And we have this huge discussion in Poland, oh, was it 3 months too late? And then we ran our models and show them that it would impact it would reduce the inflation by 0.1 percentage point at the end of last year. So you know, it's not that simple, and I understand that the Eurozone is even more complex, so it's...
Okay, well, I think that's fair enough. Yeah. Just a couple of questions on these fascinating reserve asset trends. You spoke about the correlation in the asset prices between bonds and equity, and you mentioned the big fall in the treasury valuation. I imagine it's the same, probably even worse, in your holdings of German government bonds. Could you explain your holdings of gold in that context? That does seem to be an effort to bring in another kind of hedging instrument into your central bank reserves.
That's right. We hold gold, and we increased our holdings of gold over the last years, and we think it was a very good decision because it does tend to store value well, and also it's a hedge, you know, when there are these turbulent times, so it behaves better probably than our other holdings. But also we think that when you think outside the box, that it's also, you know, a hedge against, I don't know, cyber security risk, and so yeah, I think
and I believe you actually hold a lot of the gold in Warsaw, and you say this is somehow safe in Warsaw. Do you actually believe that yourself, given latest developments?
I don't think we disclose where we hold our gold.
Just a final question on the asset allocation. A feature of our survey has been that people want to carry on building up their reserve assets, and you've done this. You've now got 120 billion of reserves. On the other hand, in the event of a real crisis, there would be an opposition by the reserve managers to run these reserves down too much. What do you think is the essential point about reserves? What is the essence of having 120 billion of reserves for you in the
all sorts. I think we are more credible as a state when we hold lots of reserves. Our credit ratings it contributes to higher credit ratings. I think we are more solvent as a state when we hold outside, I'm talking about outside solvency, when we hold lots of reserves, and also I think it protects us against too much FX volatility, so there is definitely a lot of reasons to keep accumulating.
Good. Well, there's many other questions I could put also on the ESG area, but there may be an opportunity perhaps to catch up also with members of the audience. I'm sure that if we had questions from the audience, you'd have been here another hour, Marta. But I would like to congratulate you again on this wonderful speech where you really did hit the nail on the head in a number of ways. So thank you very much indeed for coming.
Thank you.
And I'm going to hand over to Ellie. This has just been a warm-up for Ellie Groves, ladies and gentlemen.
Thank you very much.
Thank you, David. I'm also going to welcome the panelists that are here in person to join. I don't have to see you there, so thank you. Do you want to sit here, Didier, and then Neil, and then Ivan, and let's see, we have two, I think, perfect. Thank you. And then we also, so thank you very much for joining us, and thank you to the panelists and also to Marta for that very interesting discussion with David. So we have today discussing with us Øystein Olsen, the governor of Norges Bank up until earlier this year. Very pleased to welcome you. We have Mathilde Mesnard, who's the Deputy Director for Financial Enterprise Affairs at the OECD. She's joining online, so I believe we'll be up there in a moment. So then we have Ivan Fayella, who's the Coordinator Climate Change and Sustainability Hub at Bank d'Italia. We'll be talking about those ESG themes that David just mentioned as well. Then we have Neil Williams, who's Chief Economist at OMFIF, to give a little bit of flavour from the GPI report. And we have Didier Borowski, who's Head of Global Views at Amundi. We also have online Bing Fan, who's Head of International Index Strategies and Senior Portfolio Manager, has almost a longer job title than I do, E-Fund Management. So very pleased to have him join us too. So I want to start, if we may, with Mathilde from the OECD to give offering as a global macro view on inflation and growth from the perspective of the OECD. We heard earlier that that's the key issue for central banks. It was a key theme through Marta's keynote, so it's interesting to have this perspective. So please, over to Mathilde.
Thank you, Ellie. Just to check that you can hear me well.
Perfect.
Okay. Thank you. So I'm afraid I have a rather gloomy set of observations about the global macroeconomic and financial outlooks. Our discussion today takes place amid heightened geopolitical tensions, that's clear, and the ongoing pandemic. It's also very clear from Paris, I can tell you. Russia's war against Ukraine continues, and with it the suffering and destruction of human lives and livelihoods. More than 7 million people have fled Ukraine since the outbreak of the war, and even more are internally displaced. So the damage to Ukraine's economy and infrastructure is extensive and growing by the day, as unfortunately we can see on the news. But the repercussion of this war goes well beyond Russia and Ukraine. The war is adding immense uncertainty to the global economy, which was just recovering from the pandemic. And private investment and downward revision of 1.5 percentage point with respect to our December 2021 projections. And we are also expecting further slowing in 2023. Projections for consumer price inflation have been revised significantly upwards. We project inflation to average 8.8% in the OECD in 2022, before receding slowly in 2023 as supply chain and commodity price pressures wane. So the war in Ukraine has erased hopes for a quick end to rising inflation from COVID-19 related supply bottlenecks seen across the global economy during 2021 and early 2022. Our projections in June show the large and global impact the war is having on inflation, which has already reached 40-year highs in Germany, the UK, and the US. The war has triggered a cost of living crisis affecting people worldwide. Price hikes undermine consumption everywhere. Rising inflation, largely driven by steep increases in the price of energy and food, is causing hardship for low-income people and raising serious food security risks in the world's poorest economies. Without action, there is a high risk of a food crisis. Russia and Ukraine are important suppliers in many commodity markets. Together, they accounted for about 30% of global wheat exports, 20% for corn, minerals, fertilizers, and natural gas, and 11% for oil. And prices for these commodities increased sharply after the onset of the war. Avoiding that low-income countries are dragged into a food crisis is a major global challenge that requires a common effort. This economic situation in the short term requires bold, well-designed, and coordinated policy measures. At the same time, structural challenges remain manifold, from aging to climate transition, from digitalization to energy and food security. And the outlook for financial markets is also highly uncertain. A combination of global geopolitical uncertainty, higher commodity prices, sanctions, and regional business disruptions has contributed to elevated volatility and risk aversion. The immediate impact of the invasion was a sharp rise in commodity prices and severe equity price declines that mainly affected Russian markets. Corporate and sovereign credit market conditions deteriorated substantially beyond the Russian market, particularly in several emerging markets in Europe and Asia. And Russian banks experienced severely strained conditions, and spillovers affected some international banks, particularly European banks, with substantial exposures to Russia. Volatility has risen substantially in US Treasury and equity markets, with investors concerned about the surge in global commodity prices and subsequent acceleration of monetary policy rate increases to address high inflation. That said, after initial deterioration of risk appetite in the early days of the war, performance of global equity markets and credit market conditions has generally improved since mid-March, and investors have reassessed their outlook for risk assets and become less risk averse. But the war could have important implications for longer-term structural vulnerabilities in financial markets, especially for emerging economies. Elevated sovereign debt levels and high refinancing needs could increase refinancing risk for sovereign issuers. And emerging market economies with direct links to Russia and Ukraine would also be particularly vulnerable to commodity supply chain disruptions that could contribute to weakening economic growth and higher inflation. And many emerging economies also recorded in portfolio outflows in February, March, and April. So these conditions also increase the risk of downgrades and defaults, which may undermine the resilience of financial intermediaries and structured financial products. With high level of sovereign and corporate leverage, combined with tightening fiscal space in many countries, deteriorating credit and market conditions could affect financial system resilience. So that's it. I mean, I hope that sets the scene for the macroeconomic and financial outlooks. I'm sorry for being so gloomy.
No, thank you very much. I think it's a comprehensive overview. I'm hoping that the panelists we have collected here will be able to bring some positives into the conversation. For sure. So Didier, I want to come to you and ask if this is reflective of how you see it in the markets from the perspective of fixed income and equity markets. could I please ask if you could, you have to share microphones, apologies for this, but we'll pass it around.
So we understand, okay, that the outlook is gloomy, the economic outlook is gloomy, and we share this point of view. Global growth is going to decelerate, in particular in the Eurozone and in the United States. We're a little bit more optimistic when it comes to emerging markets, and it has an implication on our asset allocation, in particular regarding China. We do believe that in China the worst is over and that we'll see an economic rebound. So at some point there is a great fragmentation at the global level regarding the business cycles, the economic cycles. So, and I would say from an investment standpoint, it's good news, because when there is fragmentation, it means that we'll see some investing opportunities. Regarding the global environment, it's all about stagflation. So what is stagflation? Stagflation is an environment where you can see at the same time a recession or a sharp economic slowdown and still inflationary pressure being very elevated. We believe that we will stay in this stagflationary environment, and it has very important consequences on markets, because we saw since the start of the year a positive correlation between bonds and equity markets. We don't believe that this positive correlation will end very quickly. The bulk of the adjustment, so the great repricing, I would say, has already occurred. The overvaluation on the equity markets has been absorbed. That being said, when you look at the economic outlook with a top-down perspective, when we look at earnings, for instance, our earnings forecasts are still quite gloomy. We believe that an earnings recession is still something that is possible in the Eurozone. An economic recession is something that also it's a key risk. We believe that earnings forecast, even in the United States, where so far the US economy is resilient, earnings forecasts are too elevated. So that's true that we've seen a big market correction, both on the equity side and on the fixed income side. There is no more overvaluation, but it's true also that at the same time, equity markets are not cheap. Bond markets are not cheap. So we need to be very careful, and it's not time to put it in a nutshell to add risks in portfolios. So the bulk of the adjustment has happened. That being said, the outlook is gloomy, in particular in advanced economies, in particular in Europe, because it's a huge asymmetric shock, the war in Ukraine, and it's too soon, clearly, to add risk in portfolios. There is a quick question when bond yields are going to stabilize. That is related to the central bank reaction function. The first sequence of central banks' monetary policies is clearly to be hawkish in order to, and I think it was very clear with Martha Knightley, to anchor inflation expectations. And we are not out of the woods regarding inflation expectations, so the Fed will continue to hike aggressively in the coming 2 months. The ECB will start hiking rates. It's already priced in. We simply doubt that central banks, in particular the ECB and the Fed, will be able to be very aggressive in the second half of the year. So it may give later this year some investment opportunities. We believe regarding bond yields, because it's the key, I would say, to re-enter more aggressively on equity markets. Regarding bond yields, we believe that investors' behavior will cap the rise in long-term interest rates. For instance, we estimate that close to 3.5% on the 10-year bond yield, some US investors will be keen to invest on the long end of the curve, and probably not only US investors. That's an interesting point, because it may really trigger a change in asset allocations looking ahead, but we are not there yet, and we are still worried by the fact that bond yields may still jump once again on the long end of the curve and weigh on equity markets. There is a final leg on equities that has not yet materialized when we look at our own forecast. That being said, the great, I would say, divergence that we see looking ahead is very important. Financial markets are very fragmented at a global level. You have very different real interest rates. The search for yield will come back to the fore by the end of the year. The dollar, we believe, will peak at some point during the second half of the year and give some investment opportunities for investors who search for yield in the EM space. And we have started to do that, in particular regarding our exposure to Chinese equities. And we continue to believe, for instance, that the Chinese bond market is a key diversifier in our global fixed income portfolios.
Thank you very much. We will be coming back to that towards the end, but I want to go straight to Neil here to reflect on some of the context that Taylor did an excellent job presenting the key findings of earlier around what we've heard and seen from the central banks that we've surveyed, and also the wider context of exactly what Didier and Mathilde set out, a rather gloomier picture than perhaps we were hoping to be this time last year.
Thank you, Ellie. Well, whoever described economics as a dismal science clearly had no idea what they were talking about, but you do have the risk of at least 3, maybe more economists agreeing on this. First of all, on the survey itself, if I may, important survey, not least because it was the first complete survey of its kind after the conflict started. So even if the main findings conflict with your own way of thinking, if they do, you can't really blame that on the purity of the data, which I find very helpful. Second thing is Taylor's set out, there are 3 elephants in the room really for economies and markets from the survey. First is inflation, second geopolitics, and thirdly, I think rightly, concern about rolling back of ultra-loose monetary policy that we've seen for the last decade or more, not forgetting that there's about $20 trillion more in the system than there was back in 2008, which is pretty much yet to be pulled back. Just 3 quick observations, just to prove an economist can talk for fewer than 5 minutes, which I've never done before. Firstly, on inflation itself, clearly reserve managers are preparing to some extent for higher inflation rightly, but are not phased. Now, you might expect them to admit they're not panicking. However, their actions bear that out. And I say that because although almost half say inflation set to be higher, almost half suggesting that it won't be and or is temporary. And coupled with responses regarding, for example, COVID, unfortunately, by 90%, still a major factor on growth, suggests to me that the debate about the wrong sort of inflation is still very much there. And certainly behind many reserve managers' minds is that this could be predominantly still stagflation with implications for policy rather than sort of good old-fashioned demand inflation. On their actions, asset allocation, I think one surprise, to me at least, was risk is still on the table, despite all these economic headwinds, suggesting that maybe the fiscal stimulus that we had in early 20, which was part of the risk on, they're not expecting that to be pulled anytime soon. Also, in terms of their exposures, equities and gold being the obvious inflation protectors, David mentioned gold, but equally no en masse move out of those assets you might think would normally be affected by inflation or hit by inflation, predominantly fixed income. And a surprise to me is also that within the fixed income sphere, a net move down yield curves. Now you may say that's a way of reducing duration and thereby inflation hit, but I wonder if reserve managers would do that if they were concerned that money markets were underpricing the extent of interest rates from here, suggesting that maybe the people managing the reserves are quite relaxed about the guys upstairs who are setting interest rates for their central bank. Be interested to hear the audience reaction to that. And very finally, if I've got a minute.
Just about.
Thank you, Ellie. Is that just on the FX reserves currency issue, renminbi set to gain, dollar still king, but no obvious scramble to the traditional safe havens, such as US dollar, Swiss franc, and yen. Again, giving some reassurance that they're not expecting any sort of economic Armageddon to come, which obviously is encouraging. Also on the reserves in themselves, Taylor mentioned correctly that a slightly smaller proportion of reserve managers were now prepared to spend about a third or more on reserves fighting any future currency crisis. I wonder if that also can be taken as they feel there's less need to, given that there are fewer fixed currency pegs around these days to have to protect. So a very quick summary from me, interested in your interpretation. The first one is it gives me actually some reassurance. Risk is still on. Government bonds are still in play with a move down curve, suggesting that central banks may be not as aggressive as some out there believe they will be. Just as a quick plug, I think it will be fascinating in the autumn when we get the sister survey for public pensions and sovereign funds. Thank you.
Thank you very much, Neil. And could I ask you to hand the microphone over to Øystein? We've found a microphone out of very. I don't know if it's working. Yeah. I'm going to come to you, Ivan, in a second, but I want to ask Øystein just to continue this conversation around, as governor of Norges Bank, you navigated the COVID-19 crisis. Having stepped down earlier this year, you of course are not in the weeds, but I want to ask, from your perspective, how are central banks navigating the inflation questions? Do you think they are doing so effectively? We'll then go on to talking about the next crisis regarding climate and energy security, which are the perfect time to then bring Ivan in to talk about the central bank's relationship to ESG investing. But Øystein, if you could give some reflections on how central banks are responding to the inflation crisis.
Big issues in a few minutes.
Exactly.
Well, first on inflation, I very much share the analysis you made, Martha, and especially when you pointed at the more complex world, which we all face, but the dilemmas which are much harder for central banks than we have been used to for a number of years, since the response has always been low rates, because that stimulates both inflation and developments. Now that balance is much more difficult, because inflation is back, and with very high numbers. Now, on the question whether central banks are behind the curve, my short answer is no. I think it's too easy to just state that in a situation where things have been happening very suddenly. If I go back to September last year, then I was still in office, and in the Central Bank of Norway, we raised rates for the first time for quite some time from 0 in September, and then the Polish National Bank and some others, the Czech National Bank did the same, and I think we all had got these critical questions of being very hawkish, because could you do that in this situation where inflation is still low and the recovery is coming out, the recovery out of the COVID is there, but there is still need for an expansionary monetary policy. Now things are completely turned around, and my general view is that the major central banks have responded. They have responded more strongly, with some differences across the major central banks, yes. The ECB is perhaps behind the curve, but for good reasons then. It's a union, the decision process is much more complex than in a homogeneous individual country, so we all respect that. There are some problems with high debt levels, with Italy in front. The danger there is, of course, that there could be some effect of what we call fiscal dominance, the high debt preventing a necessary raise of policy rates. But then, my general view on the dilemma for monetary policy is the following. The dilemma is much more difficult than it has been for some time. What we experience now, is it inflation? No, it's basically a major shock in relative prices. It's a supply shock in the energy field, food prices accelerated by the war, and a central bank that causes problems for the central bank, because you mentioned it, Martha. It's first of all the secondary effect, the possible danger that these relative price shocks moves into some kind of price wage spiral. Then it's time to respond. While a central bank cannot prevent changes in relative prices. So that's one dilemma. And the second one is, of course, that if central banks could yes, they could kill inflation by creating a recession. But they won't do that, and they shouldn't do that. We're not out of the problems created by the COVID. So this causes the other very hard balance and dilemma for the central bank. They have to respond on the danger of secondary effects. And you see some compensation coming out in different camps, but still I'm relatively optimistic. We don't see the same demands for compensating every price hike as we saw in I'm old enough to remember the 70s and in the 80s. 1 minute on energy.
Yes, please. I think it would be good to.
Well, that's
future.
I already mentioned it, and it's all things comes together these days. It's the energy. The energy crisis has been mounting, or in emning, as we say in Norwegian, I think also in English, for quite some time. It's about the transition, the green transition. It's an effect of investments in energy supply, which has been going markedly down. I think it's a reduction of 40% of overall investments in energy supply over the last year. Affected by the COVID crisis, yes, but there's a lockdown of the phasing out of coal, there is a phasing out of nuclear, and even though we have increased investments in green energy, it couldn't compensate for the first things I mentioned. So energy prices have come up for quite some time, and then came the Russian invasion in Ukraine, which made energy prices moving towards a sky high. So, and then this, what's going to happen next? I think we live in a, I think it was when the German Chancellor Scholz, I think it was the end of February, just announced a complete turnaround in the strategy, in the military strategy and in energy strategy for Europe. And the Commission or the EU followed up by a clear plan of moving away from Russian imports of natural gas. That is a trigger. That is, they are not able to fulfill their plans for the present year, and because the ambition is to reduce Russian imports by 2/3, I think, by the end of this year. That could not happen. It's impossible. But the direction of that policy is remarkable. So it's very exciting to see what's happening next. What's happening with the green transition? Will there be a setback? Yes, in the short run, yes, because coal have to come back in the short run. But over time, it's the other way around. I think we have energy security issues and climate issues pointing and pulling in the same direction, namely getting gradually rid of this dependence on Russian imports. And I should mention Norwegian imports of natural gas, because Norway is a significant supplier of natural gas to Europe, about half the size of Russia, by the way, with limited potential of compensating for a reduction of Russian imports in a short run. Thank you very much.
Thank you. There's a lot to reflect on there. And I want to go to you, Ivan, because I want to expand on the theme of developing the ESG investing and the role of central banks within the ESG investing and furthering the climate agenda.
Okay, I'll try to be positive. Well, then I just would echo the point of central banks should prevent relative price changes, because I think that they are part of the solution, because they provide information regarding demand destruction, and they are an important signal for the supply, no? That there is, there are profits out there, so you have to expand the supply. So I think that's really important. The point is that we are always facing uncertainty talking about the transition. We had uncertainty on the effects of climate change. We had uncertainty of the timing of the policies. Now we have the uncertainty of what's going to happen. Everything is going to be stopped? I honestly think that, I'm an energy economist. So, for an energy economist, there is this energy trilemma. So energy is like a stool with 3 legs, and it's going to stay there. If you have the 3 legs contemporary, there is, energy should be sustainable from an environmental point of view, but should be also affordable and secure. So I think we are just relearning, that energy security is part of the story. So there's not going to be a transition without energy security, energy affordability. So definitely this is a story. What is the role of a central bank? Well, let's not forget that we are, I don't think that we are going back from these things, because there is an issue of reputation. I just make an example of the Italian central bank. We have a charter, we have a mission, we have a vision, we have targets, and we believe about that. That said, we are not setting carbon pricing, we are not setting targets, we are not deciding if the coal power plants are going to back in line because of energy issues. So I think that it's a thin line to walk there, and there will be trade-offs. That is clear. Honestly, it's clear that if you are punishing energy-intensive sectors now, you are still providing a signal against providing more supply of things that is really needed out there if you want to reduce prices. At the same time, there are solutions that are going in the same direction, a win-win solution. Do not forget that ESG investing, and in general, reducing the climate risk in your portfolio is something that increases the resilience of your portfolio and provide resources to the real economy solution that increase the resilience of the system. My point is that these days, if you look at the Mediterranean, we are suffering probably the biggest heat waves never recorded. And these things are going to happen more and more, like flooding. I mean, we know that. So we have to act anyway, and we probably have to act trying to find those solutions that at the same time decrease if you want, the energy intensity and the carbon intensity of our energy system, and at the same time reduce also energy dependence. That's the only point. There are some of the solutions. I think, for example, that there are many good ideas provided by the International Energy Agency just in March regarding demand-side management. Are all things that, again, unfortunately, are not in the hands of central banks. But central banks, you know, they can provide example, they can provide analysis as well, and if you want assistance also to the governments, you should take this decision. Obviously, again, here there is also, apart from sustainability issues, social issues regarding the cost of these things. I honestly think that we were always saying that this transition would be cheap. I mean, if you look at paper also of 2009, 2010, and I think that's obvious because you have to change all the energy system. You have an issue of stranded assets. You have an issue, if you look at Italy, Germany, Spain, of, you know, feed-in tariffs, how these things are going to push up the energy bills of households. And in fact, many European governments now are just, you know, freezing those supports. So the point that the transition is going to be costly is a factor. Let's say that now these super high fossil fuel prices are making the transition less expensive. So that's the good news. The only point is to see where these things is going hand in hand with improving energy security, energy resilience. That's not going to be easy. My last point that we are walk the talk, if you want. So we are moving from a moment where there was a lot of rhetoric, a lot of statements, to a moment where we need to take action. And I think a very positive thing of the crisis that central banks are learning that energy markets exist. There is not just labor market. There is not just a Philip curve. And energy markets are not simply oil. It's gas, is the power market, our power markets rules. These things is going to improve our knowledge, our modeling, and I think it's going to improve also the way we are targeting inflation. I completely agree with the former governor that up to now the inflation is pushed 99%, at least in Europe, by supply factors and not by demand factors.
Thank you very much, and I definitely want to continue the point on ESG. I saw, Didier, you wanting to come in, I believe. So I want to come back to you as well, but I also want to have audience questions. So you have about 5 minutes to think of your questions as we come in to Mr. Bing from eFund. Before we do, and I think it's important to also talk about resilience and diversifications in portfolios, especially in perspectives of China and the global flows around the RMB assets and how reserve managers are starting to pick up exposure to ETFs. That was another key theme that came out last year in our survey and is still present in this one too. So Bing, I want to come over to you, please.
Thank you, and it's my pleasure to be here to share virtually on China investment case. The rising interest rate and the soaring inflation, as many speakers mentioned, is really a challenging macro environment, and that'll be challenging including China as well. But in my opinion, I hope China can be the silver lining to the cloudy weather. The investment case for China, in my opinion, is intact, still intact as of now, but become much more complicated given the macro environment. So traditionally, when we visit China, we always talk about three things: the size of the economy, the growth story, and the diversification. And we can look at each of them in the next 2 to 3 minutes. For the size-wise, everyone knows China's GDP is 18% of the global GDP. But if we look at the allocation numbers, majority of the data or the survey or the investors we talk to significantly under allocating to China. Starting from this year, between January to April, I think that makes perfect sense because China assets was actually one of the worst performing assets during the starting of this year. But things are changing rapidly after May of just 2 months ago. So starting from May, China equity markets already rebound significantly. And year to date, the first half, China asset markets, China stock markets already become one of the best performing as of now. So many investors coming to us looking at the simple combinations, that the combination for the rest of the world is a rising inflation, tightening policy cycle, and the valuation facing a headwind. But for China, because China's business cycle is roughly half a year ahead of the rest of the world. China is the first one get hit by the COVID, and the first one control the COVID, and the first one start tutoring the policy cycle. So now looking at China becomes a accommodative policy and a relatively low inflation, plus relatively attractive valuation level. So starting from May, we do see the money coming back to China markets, not only the H shares, but also China A shares. If you read the notes-bound fees, if you read the overseas listed China SIMD ETFs, all the data seems giving us the same picture. So the second one, when we're looking at the growth, as I think Matilda mentioned earlier, so the OECD forecast for the global GDP growth has been revised down. But still, China is a relatively better position in terms of the overall global GDP. And we all know that growth is one of the best cure to many challenges. And Chinese government is definitely advocates about this. I think for the toolkits from China government, there's still a lot of things can be done to trying to achieve a GDP, if not 5.5%, but maybe around 4%. Much of the measures will be coming from the fiscal policies for the second half of the backbone of the overall China stock markets. And the areas like a digital economy, energy transition, or even the wealth management, in my opinion, it would be the areas may deliver a relative return for the second half of the year. Overall, on the rising interest rate policy, very hard to get the absolute return, but relative return from China for the second half of the year is something worth mentioning. Also, the allocation to China, according to the survey data, we can see it's actually rising as well from a very low base. And of course, most of the allocation to China is still going to the fixed income side as the investors has become risk averse during these macro environments. But we do see a pickup on the usage of ETF. So if we make a deep dive into the ETF data, globally this year, most of the income or the inflow is coming from retail investors. But it seems like the institutional investors who is using ETF to gaining access to China as an allocation tool is also picking up. And allocating to China, maybe at the moment, we're starting from the satellite strategies, but more and more people will adopt ETF as allocation to gaining access to China. I think I'll pause here to see if anyone have any questions. Thank you.
Thank you very much. That was very interesting and a good perspective from a different region. We have Europe very well represented in the room, so very, very pleased to have that. Meghna, you have a question. Please do pose it. There's a microphone just coming to you. So, very.
I wanted to ask a question about the energy aspect of this thing. What we are finding here that the amazing rise in the price of energy is forcing people to economize, whether they like it or not. I mean, it's not that people are shifting to new forms of energy, but they just have to use less energy. So was inflation a cure for the zero carbon policy?
Thank you, Lord Desai. Didier, do you want to pick up on whether it will be a consumer-led reduction in inflation?
Well, inflation is not only cyclical, so for sure if you have this loss in purchasing power, the economic momentum will lose ground, and at the end of the day, the cyclical leg of inflation will diminish. In particular, I would say in the United States, where inflation is partially driven by demand factors and fiscal policy was excessively accommodative probably last year. While, as it was said, in Europe, inflation is not that much driven by demand factors. So my point is that the supply side factors will continue to exert an upward pressure on prices, and core inflation is expected to continue to rise and to accelerate in the Eurozone on average by the end of the year. And even if you have a recession or a technical recession in the Eurozone, it will not generate this usual disinflationary pressure that is traditionally associated with recession. And it's all about stagflation, because we have in mind the 3 or 4 past decades where inflation is only a lagging indicator of the economic cycle. When the economy slows, when you have a recession, you have a disinflationary trend. We're no longer living in this environment. So we can have a recession. That's all about stagflation. You can have a recession in the Eurozone with still high inflationary pressure. That's the key point, and that's the big headwinds, I would say, for the ECB and for central banks in general.
Thank you. I also, Mathilde, do you have any perspective on this from the OECD? And then I'll come to you, John Orchard.
Well, clearly, I mean, I agree with Lord Desai. Clearly, people will have to economize. I mean, and this might slightly reduce the growth. I mean, slightly reduce the inflationary pressure, but only to some extent, because it's really a supply side inflation.
I think the question that, thank you, the question that I had with conversations with the ECB that we've been having at OMFIF has been one of their positives. So they've obviously got a lot of headwinds that they're pricing into their models, but one of their positives is the savings that have been built up in COVID. And what's been interesting is the question is whether those savings will now be spent on the rising energy prices, and actually therefore their positives, their base case scenario seems to be less probable than before. So I definitely think that that is one to watch, and that's something they are looking into and considering about that the savings buffer that they were pricing into their base case, I think, is under threat. But John, do you have a question?
Yeah, Ellie, you and I were in a major central bank that's based in Europe a few weeks ago, and I formed the impression there's a strong argument there that the best policy, beyond a bit of tinkering with QE to solve certain problems, is to do nothing from here on in, because the incoming recession will save them having to change monetary policy. So what do the panel think about that?
Neil, do you want to pick up on that from the flight to safety? I think it was both reflected in Taylor and also you. So are central banks sitting on their hands and waiting it see-through? And then I'll go to you, Oisin and Ivan, if you want to pick up on that.
Yes, certainly. I mean, just 3 quick points. Firstly, going back to the previous one, energy important from a macro level. Taking the UK as an example, if the people who measure the fiscal numbers are correct, we've got the sharpest potential drop in real disposable income this year than we've had post Second World War. So anything too aggressive from central banks on that level, therefore, does that help with inflation, or does it simply batter the economy into recession? And to take John's point, we know that the major central banks are desperate to get back their cherished policy tool, the key policy interest rate, without which they feel pretty much exposed. Because what do they do next time? Well, of course, the difficulty there is that with energy prices high and with other things happening as well, that they simply tip the economy into recession if they move too quickly. So I think the image is to gradually get rates back up. We're talking here a move from very negative real rates to slightly closer to zero negative real rates. And for those of us, in fact, Oisin and I can remember the 70s as well, just about. For those of us who do have a longer-term perspective, these are baby steps. These are very, very small moves. And putting everything together, I agree with John. Seems to me that if anything, we're going to end up not close to the old normal, where interest rates would average 5%, for example, in the UK and the US over the longer term. but a new normal whereby things really are low for much longer, with the attendant pressures of the difference between the haves and the have-nots. Sorry, that was meant to be a short answer.
No, that's fine. Listen, do you have any perspective that you want to offer to whether central banks are seeing through the inflation, or I think it goes back to the timing and sequencing of the hikes that you saw?
Well, we have already touched upon the issue, and given the high inflation number we see now, the central banks have to react, and they have responded quite strongly, as we already heard. But again, they have to be aware of these secondary effects, and we see some secondary effects. We see a number of secondary effects. We see compensation, wage demands are coming up. Norwegian pilots these days are striking, although their wages already is at high levels. So I think you see this in many countries that you have secondary effects, and central banks have to respond on that. But my point I made also is that the central banks cannot counteract changes in relative prices. So they have to find the right balance between analyzing what's the feed through and the possible danger of entering into a wage price spiral. And then we have considerations to real developments, the real economy. Now, in the outset, of course, if you go back to 2021, I mean, the starting point was a very strong recovery in the global economy. So there's a strong recovery, and also that fact points to the strategy for central banks, I think, to finally seek to come out of this low zero interest trap. So from that perspective, it's fine that the situation is changed in the direction so that all or even major central banks can come away, can avoid these two rates which are too low and which create a number of problems. But again, the balance going forward is difficult to balance the danger for increased inflation or sustained inflation towards not killing the recovery, because that's too early.
Yeah. Ivan, do you have any words on this?
I would like to answer to the previous point on the effects of energy prices. I would like to remind that energy price increase is rather heterogeneous across the income distribution. Let's imagine that the share in Italy, at least, of power expenditure on total household budget is 5% for less affluent households, and it's less than 1%. So the possibility to react to a price increase for a less affluent households is almost zero. So this means that all the energy increase, or all the increase in price is just going to be translated in more expenditure, and then eventually to a compression in household income, disposable income. So my point is that governments should protect those guys as much as possible, and should protect them if possibly not messing up too much on price signal. So with direct transfers, improving their housing, for example, energy efficiency and this kind of stuff. Because up to now, what's happening in Europe is that most of the governments are freezing the price signal, and at the same time they are telling households probably you're going to curb the use of gas or whatever during the winter. That's pretty weird, because I would say, price signal is the better way to curb the very inefficient use of energy. That's the best way. And putting all that money, because freezing prices means increasing debt at the end of the day. Put all these resources across the board, or in Italy, 25 million households. It's peanuts. While targeting this resource towards the vulnerable, it would be super effective. And if you have a long-term perspective, as I said before, maybe you are changing the energy efficiency of social housing. So you are doing something that is reducing the energy bill from now on, and reducing the demand of energy is increasing the welfare of vulnerable people, and at the same time is reducing carbon intensity. because maybe you are using renewable in the power sector, you're increasing the use of heating pump and this kind of stuff. So my point in the right reaction should be, you know, after the first shock, and it was completely understandable that everybody was waiting, you know, this is something transitory, is going to last 1 month, 2 months. Now it's time to understand that probably the new normal for the median household would be having not 6% of their budget devoted to energy, but maybe it's going to be 10 or 12%. That's not going to be a tragedy for the median and the upper income households. It's going to be a real problem for less affluent households.
Thank you for that perspective. Arnab, you had a question, so Arnab Das, please put the question.
Thank you. Yeah, so I had a question about the proposition that the growth-inflation trade-off in the world is changing. If we go back before the pandemic, you know, up to, let's say, all the way back to the global financial crisis, it seems that in much of the West, services were the main driver of inflation. If anything, goods prices were dragging inflation down, and commodity prices sort of going back and forth, and over a long period of time, sort of neither here nor there. Then during the pandemic, we had this great shift, reallocation spending between goods and services because of the lockdown. And then with the reopening, we've had this big shock in spending, in goods shifting to services. And now with the war, we have this big shock in commodity prices. And in the background, we have this change in globalization going on, which is probably going to involve sustained higher trade and investment barriers for a while, especially with some countries and maybe with many countries, right? Not least between the UK and the EU. So I wonder if you put all of these things together, it doesn't mean that we are facing somewhat lower potential growth. People often say, you know, we're in a structurally higher inflation environment. Doesn't that really mean we're in a structurally lower trend growth environment if we decide that we need to maintain price stability? And therefore, I guess my question would be, what does this look like over the longer term once we get through these shocks? What kind of a world are we looking at? Is monetary policy going to need to be structurally somewhat tighter? And just to make things easier, throw in the labor market, right? I mean, we've had a big shift in the labor market in the US and in the UK, which there are elements of in the Eurozone as well, because the labor market appears a lot tighter than it was. Thank you.
Thank you for that question. And we have about 5 minutes left, so we'll answer this question, and then I'm going to go to each panelist and to Ming as well. Is Mathilde still on? Or is she? Because no, I was going to ask if she wanted to pick up on that question, but she seems to have dropped off, so we can come back to her to get her there. And I want to ask each panelist to close, so I'll give you a little bit of time to think about it on what is your biggest worry, what is your fear for the future, where do you think the next crisis is going to be, just to end on a funner downer, but I'm sure that we can also integrate into that how you think that the institutions that that we have are set up to rise to those challenges. So first of all, are we looking at a low growth, slower growth environment? And why don't we start with you, Øystein?
Well, you know, at least not economists were not able to foresee the financial crisis. We couldn't predict the COVID crisis, and not to speak of the war. So I think I'm going to be quite careful to sort of to say something about the next one. Instead, I would like to comment to the last remark from the gentleman down there, which is I fully share the implicit view you had when you talk about structural, international, global forces affecting both real developments, but also pressures on prices ahead of COVID, downwards. I mean, the central banks have struggled for quite some time to bring inflation up towards target. And the obvious reason is that we have strong global forces, global competitiveness, China and emerging economies coming into the world market and explaining why that has been difficult. Now it's the other way around. You have structural shocks, supply shocks, which we have touched upon, which have brought inflation at high numbers. And central banks, what I'm saying is that central banks have complex, advanced analytical frameworks which seek to explain inflation prospects, but these structural forces are not part of that framework. So it's too simple. Central banks do understand that. They should understand that and be aware of that. And my general response and perhaps advice to central bankers is that inflation the conduct of monetary policy has to have been in terms of flexible inflation targeting, flexible, not seeking to fine-tune any number, because given these structural forces, you will not succeed to hit those numbers exactly. Thank you.
Thank you. Bing, I'm going to come to you to have your reflections on the structures, the global geopolitical structures, and any perspective that you have on where you see the future of the global economy as well. So it's a small question.
Sure, thank you. Now I'll share my 2 cents with 2 points. So number one is in the challenging macro environments like now, going forward maybe for the next 1 or 2 years, many asset classes will be struggling to deliver a positive real yield. So in these environments, any assets able to deliver relatively higher real yield and also have a very deep depth and also the high varieties, China hopefully will be one of the best candidates to deliver the real yield, especially China equity. That's point number one. Number two is hopefully my sharing can encourage the more adoptions of ETF, because the modern ETF nowadays, with the product innovation and much variety of product offerings, the ETF strategies already sits in the middle of traditional passive and the traditional active strategies. So it can be used for either the building block or the tactical or strategic allocations. That's my point. Thank you.
Thank you very much. Neil, I'm going to come to you, then Didier, then Ivan to close. So Neil, your thoughts on the low growth environment?
I got so excited when Arna asked his question, I was writing furiously, my pen ran out, which suggests maybe there is a liquidity shortage after all. But completely agree, maybe the rotation from services to goods is prior to COVID, the rotation from goods to services is then reversed if we, for example, enter a more protectionist regime, which isn't a sexy topic to talk about because it's not a cliff edge event, it's more of a crack in the eyes. But for me, geopolitics is important going forward when such things as the blame game starts for various issues, and we may, if not see protectionism, then certainly, in my view, we're chipping away at the globalization we've seen, in which case is it easier to export or import a service than it is a good if physical barriers, and people, of course, if barriers are there. And secondly, just very briefly for central banks, if fiscal policy is going to play a greater role now in keeping growth going along while central banks try to get their mojo back in terms of getting some interest rates under their belt, how real is quantitative tightening, selling the assets back into the system, in which case their balance sheets remain bloated, in which case liquidity remains plentiful. And the thing that keeps me awake at night on the macro front is got very little to do with aggressive central banks, but more to do with an increasing disparity between that have assets and those that don't, and what that may mean, not just economically, but socially.
Thank you very much. Didier, Neil, if you just hand the microphone over to Didier, that would be very helpful.
Yes. I'd like just to adopt a more longer perspective, just saying that we are trapped in uncertainties in the short run, but looking at the longer run, there is a collective challenge which is reaching the net zero objective, and we believe that in fact these supply shocks may offer an opportunity to our governments and to our investors to accelerate the energy transition. We understand that in the short run it will be very challenging, but looking ahead, there is no choice but to accelerate this energy transition. And I think both asset managers, investors, and governments need to work in tandem to find the right way to channel excess savings toward, new investment projects. And this is the only way to exit this trap of low growth, high inflation. My point is to raise potential growth. So you have the structural reforms agenda, but there is also these massive investment projects that at some point may elevate the level of potential growth in the medium to long run. So that's, I would say, a hope that we have, but we should take these huge challenges as an opportunity. That's the point, to accelerate the energy transition.
Thank you very much, and I think that brings us very nicely to either of your closing remarks and on the energy transition, and also, if I may, how central banks communicate that to the wider audience. I think that that's very key in something the NGFS and the Network for Greening the Financial System is looking at as well, is how to communicate the ESG investing from central banks into the wider audience.
Yes, connected on potential growth. I think that the forecast track record of economists is pretty poor, but I think they can improve if we think that that's for sure climate effects are going to decrease potential growth. I mean, that's obvious, no? In terms of extreme events, in terms of chronic events, and that's a key ingredient potential growth of the tools that central bankers use to assess inflation. I agree also with Didier that I think that the transition and also adaptation action, I think will give a lot of opportunities out there. There is an issue, I touch upon NGFS, that is what we call regional rivalry in climate scenarios. So the world that we are expecting in the future is not a world where we are expecting, big cooperative action to fight climate change, to have coordinated, imagining carbon clubs or carbon border adjustment, because the issue would be that every country probably will try to get their energy system on track, given the general situation. But climate change is going to be out there anyway. I think, and I agree with you, that the NGFS work was just great because it's showing the issue. And also, the thing I like most from NGFS is that it's pretty practical. I mean, there's no principles out there. You are not negotiating like in the G20 and G7 sentence. You are just showing, these are the scenarios. This which probably can happen in the future. You should take action. Or you should at least be protective. I mean, if you don't want to be proactive as a central bank, because as I said before, that depends really upon the policies that are out of the realm of a central bank. At least you should be protective in terms, is your action in terms of pursuing price stability or financial stability somehow impaired by what's happening out there? It's your balance sheet taking too much risk because you are too much exposed to physical transition risk. I think this really changed the dialogue between central banks and financial supervisors. Let's hope that this is just a short parenthesis before we are going to be back on track towards the net zero, as was said before.
Thank you very much. We've actually run 5 minutes over. I believe we started 5 minutes late, so we kept to time. I'm going to hold to that. So thank you all for joining us. Thank you for being with us today as we launch this very snazzy report. And I also just want to finally thank the team that put it all together, to Taylor, to Clive, to all the research team, to Avnish, who organised this wonderful launch, and also to Amy and the logistics team, who made sure that there were croissants and coffee, which I believe there is some coffee still out in that room that you can chat with the panelists for a few more minutes and then get back to your days. So thank you all, and thank you very much for joining us, and thank you to the panelists.